So, welcome back everyone. I want to welcome you to the last series on cost, volume, profit analysis. So, this is the last series under the episode. The last presentation and lecture series and class on cost, volume, profit analysis. In this last series, we are going to be looking at a very substantial subset of CVPA, which we refer to as the margin of safety, MOS. But quickly, I would like to reiterate the previous sections or learning sections that have been treated in previous slides and lecture series on cost, volume, profit analysis, where we look at the concept of CVPA, the definition, the rationale governing it. We've also looked at the assumptions, different assumptions that governs the application or the validity of CVPA. We've also looked at different computations, the equation technique, contribution margin or marginal income technique. And lastly, we've been able to look at the formula, including some simple illustration as far as CVPA is concerned. So, lastly, we'll be looking at the concept of the margin of safety, MOS. What do we refer to as margin of safety as far as CVPA is concerned? Margin of safety is expressed or is simply the amount at which forecast revenue exceed or fall short of that required to break even. Let me enable to tie the definition together. Now, according to the Chartered Institute of Management Accountants, CIMA in UK, they propounded this definition and say that margin of safety is simply expressed as the amount at which the forecasted revenue exceed surplus or falls deficit short of the required amount to break even. In other words, margin of safety is the difference between the forecast sales at profit level and sales at BEP level. Now, I need to get it very well. The margin of safety is simply the difference between the BEP level. Don't forget that at the BEP level, there is no profit, there is no loss. And the volume of sales at the profit level. Are you getting it? Let's take back our previous illustration of XYZ Nigeria Limited. The sales at the BEP level is 25,000 units. Are we there? While the sales at the profit level, don't forget we're working initially with a targeted profit of 20,000 naira. We say to be able to recoup or generate a targeted profit of 20,000 naira, we must be able to to sell up to the volume of 30,000 units. So, the sales unit at BEP level is 25,000 units. While the sales unit at profit level is 30,000 units. So, in this wise, we say the margin of safety is the difference between the sales at the profit level and the sales at the break-even point level, which is 30,000 units sales at the profit level minus 25,000 units sales at the BEP unit, gives us a margin of safety unit of 5,000 units. So, I believe you've been able to get a grasp of this. That's the concept and the rationale of MOS, margin of safety. So, once again, Chartered Institute of Management Accountants defined or expressed MOS as the amount at which the forecasted revenue exceeds, 5,000 units above it, or falls below the break-even point. Though in most cases, it's actually the exceeding, at the profit level. That's what measures margin of safety. As the word implies, the margin that provides the firm with a safety. So anything that goes below that 5,000 units and drops it to a break-even point of 25,000 units, any sales below that, we put the firm to be at a detriment up to the tune of a loss proportional to the contribution margin. That's why it's called the level or the margin of safety. Equationally or mathematically, the MOS margin of safety can be expressed as MOS or M/S equals S subscript F minus SB, S subscript B in monetary value, where S subscript F is the forecasted sales and S subscript B is the sales at BEP point. So, now if we are going to express this mathematically, what we are trying to say is the 30,000 units forecasted sales, targeted sales, to make a targeted profit, minus the SB, the sales at break-even point, which is 25,000 units. The difference between the two is 5,000 units. And I always tell us in previous classes that to express a monetary value, just multiply whatever you get in unit by the selling price per unit. So in this case, it will be 5,000 units times 9 naira based on our previous illustration. So which is 45,000 naira. But you want to use the formula as expressed in this mathematical expression, then we could say the forecasted sale, which is 30,000 units multiplied by 9 naira, which is 270,000 naira. That's the forecasted sales. Now, all in monetary value now. Minus the break-even sales, which is 25,000 units multiplied by 9 naira, which is 225,000. So, 270,000 naira, which is the forecasted sales at profit level, minus 225,000 naira, which is the break-even sales, expressed in naira. This is going to give us a total of 45,000 naira, which is the same thing as 5,000 units, the difference between 30,000 and 25,000 multiplied by 9 naira. So, you're welcome to the end of the series, the lecture series on CVPA. I want to congratulate you for joining with us throughout the ship or the storms, should I say storms, should I say winds, that we pass through in the course of this tutorial. So we've come to the end of CVPA, but in subsequently released video, we'll be looking at analytics and practicals, workings and calculations in CVPA. But prior to this time, we'll be looking at a special episode, a newly packaged episode on marginal and absorption costing, as it is in the ACCA ICANN syllabus as one of the German topics. So, I believe you've been able to learn a lot in this video tutorial. Please, whenever you go and visit our YouTube channel, subscribe to our YouTube channel to be availed of subsequent resources released from this great citadel of learning. Then like the videos and subscribe and share the videos. Thank you and God bless.